To make the most of retirement, you have to think differently about everything, including investments. Coming up, we help you get ready for the mindset shift on Retiring Today. This is Retiring Today. I'm here with Loren Merkle. He's a retirement income certified professional, a certified financial planner, and a certified financial fiduciary. And today we're talking about retirement and the mindset shift that you are getting ready to get into if you're getting ready to retire. And Loren, you can empathize with this. You sit across from people all the time in visits, and they're getting ready for this mindset shift.
They're getting ready for the mindset shift because, especially when it comes to the investment planning piece of the overall retirement plan, the investment planning piece might seem more easy than what some of the other components like the income, the legacy planning, the tax planning, and all those things, because you have been investing your entire career. As you were working and you were earning income, you were probably putting money away every single pay period to your 401k plan, maybe making contributions to IRAs. So investing seems like it's very familiar. But when you retire and now you engage in something that's completely unfamiliar, which is you have income coming from a source other than you working, now it gets a little bit different, and we have to start thinking about delivering income from different sources a little bit differently.
Today we're focusing on income, but there are a lot more things that shift as you head into retirement. So we've put together some workshops that we'll talk about later, but you can go check out taxes, legacy planning, healthcare, some of the other aspects of retirement. But today we're going to focus on the investment piece of things. So let's first talk about maybe the current mindset, the way people look at investments as they head into retirement.
When you're in the working years, you're putting money into your 401k plan every pay period, and when the markets do the ebbs and flows, because the one thing we know about the market, Molly, is it's going to go up, and
I've heard you say it. It's going to go down,
and that's just a repeated cycle. It's going to go up, it's going to go down. We go through corrections and recessions frequently, so you're going to see your portfolio, and you do see your portfolio go up and down on that same roller coaster ride. You're used to that, but when you're working, that can actually benefit you, because every single time you put money into the market and it's down, you're buying more shares, which means eventually when the market comes back up, you're going to see your dollar amounts balloon because you did buy more shares at a lower cost. So the ebbs and flows of the market when you're working and you're putting money into the portfolio can actually be a really powerful tool to help you build the wealth for this day that you're not going to work and you still need income.
Okay, so you're focused on the markets in those working years. Now, let's start talking about retirement, so the mindset shift. So we want to break this down into 3 mindset shifts. Let's look at the first one. And the first thing you need to do is build a recession-resistant portfolio.
This is absolutely imperative, because now your lifestyle is dependent upon the type of income that you can receive from your investments. Your lifestyle is going to be dependent upon how steadily of an income you can produce from the investment portfolio that you have. You have Social Security, but many people go into retirement and do not elect Social Security right away. If you have a pension, you'll probably take that at retirement, so that could be one source of steady income. And then the rest of the income that you need is going to have to come from the investments. If your portfolio is still invested like you had it invested when you were working, now the market can actually start to work against you. Because when the market's not going to change, the market's still going to go up and down, and your portfolio, if it's still invested the same way, will also go up and down. When it goes up, that's not a bad thing. We love that, but it will go down. When it does go down, that can create some real hiccups in your ability to still deliver the income that you need.
I want to focus a little bit on this word recession, though. So you're telling me I need to build, or we're telling you actually, that it's a good idea to build a recession-resistant portfolio. But when I hear a word like recession, Loren, I'm thinking doom and gloom. I'm thinking like the Great Depression. I'm thinking, why would I need to build a portfolio that's resistant to recessions?
Recessions are just a natural part of our economic cycle, and it's a natural part of what the markets do as they go up and down. On average, we see recessions every 5 to 6 years. So hopefully over the course of your retirement, you're going to see 4, 5, maybe 6 recessions. It is a fact of life. So we shouldn't be surprised about it because we know it's going to happen, which means you need to be prepared for when that recession or those recessions actually do take place, so your lifestyle doesn't have to ebb and flow with the markets or with the overall economy.
And I got to stop you because I know you said this intentionally, but if you were listening closely, you literally said, hopefully you'll see 5 to 6 recessions. And I know that's what you meant, but someone's listening is going, why is he hoping I'll see 5 to 6 recessions in my lifetime?
It's a completely different way of looking at a recession, because most of the time when we talk about recessions, people do have this doom and gloom type of thought process that comes with it. But when a recession happens, like the last recession was 2020. In April of 2020 was the last official recession that we went through, and we were actually excited about the opportunities, financial opportunities that presented. Obviously, it was because of COVID and the world was, right, we weren't excited about that part, but the financial opportunities that are presented during recessions are abundant. If you have a plan in place to take advantage of those opportunities, but also if you have a plan in place to make sure that your portfolio is not going to react like the markets. And that is the definition of a recession-resistant portfolio. When we go through these recessions, your portfolio, if it's recession-resistant, the resistant part means that it's still going to go down. Right? It will resist the recession, but it will go down. It just shouldn't go down anywhere like the markets. So in 2020, in a period of about 30 days, the S&P 500 was down 34%. Your portfolio, a recession-resistant portfolio, should not be down anywhere close to 34%. If it's down 6%, 10%, that is a much better experience that you have with your investment portfolio, because remember, again, in retirement, that investment portfolio is going to deliver your lifestyle. And if your portfolio goes down 34% in retirement and you need income, the results could be devastating.
Okay, so people watching going, all right, I want whatever he's drinking, whatever he's got that he's thinking, I'm excited about a recession. So to understand how to get kind of excited about the opportunities, again, of a recession, I think you have to understand a little bit about portfolio construction and maybe the old way versus some of the new thinking we're going to get into.
Yeah, the old way is the 60% equity portfolio, 40% bond portfolio. People refer to that as the 60-40, right? You have a 60-40 portfolio. And by the way, you might have a 60-40 portfolio or something that resembles that, but you don't even know it perhaps because a lot of these 401k plans will have the life cycle funds or the target date funds. So if you're in a target date fund that says you're going to retire somewhere around the year 2030, that is in all essence a 60-40 portfolio. There's about 60% equities, 40% fixed income. That is the old way of thinking about portfolio construction. And in your working years, that works just fine. And as we get closer to the year 2030, it might become a 50-50 type portfolio. It automatically takes risk off the table. That is a really good hands-off style. But in retirement, when your lifestyle is dependent upon the investments, you have to be more intentional, and you have to give your portfolio the details that it deserves. We don't have to be in just stocks and bonds anymore. We can use alternatives and a whole list of other types of investments that we'll get into to create a truly diversified portfolio. So when a 2022 comes around and stocks blow up and bonds blow up all at the same time, then you don't have to have your lifestyle blow up. The whole intent of a 60-40 portfolio is in times where we go through stock market corrections and the stocks are down, then the 40% that you had in bonds would kind of hold the portfolio intact or maybe even lessen the losses on the stock side. But that doesn't always happen like that. In 2022, the average 60-40 portfolio was down about 16%. And if we go back to the Great Recession, 2008, the average 60-40 portfolio was down about 24%. And if you're retired and your lifestyle is dependent upon your investments, that is something that you are trying to avoid at all costs.
You might be wondering about your portfolio. How is your retirement set up? Here's a great opportunity to talk directly with a retirement planner. It's a 15-minute retirement checkup call. You can schedule one right now by going to merkleretire.com. Choose a time and a date that works for you, and you can talk about anything that's on your mind when it comes to retirement. We've got more to talk about when it comes to rethinking retirement and investments next.
Do you wonder if you have enough saved for retirement? Will your money last as long as you do? Will taxes, healthcare costs, and inflation derail your retirement? Get answers. Schedule a 15-minute retirement checkup call today. We can cover a lot in 15 minutes, including strategies you can implement now to start your retirement journey. Schedule a call at merkleretire.com. The first step to a confident retirement starts with a simple phone call.
Do I have enough saved for retirement? When should I take Social Security? Which Medicare option is best? How do I plan for inflation? Sometimes the road to retirement starts with more questions than answers. We're here to help. Join us for our upcoming Journey to Retirement workshop. Get answers and start your retirement journey with confidence. Our online workshop includes information on Secure Act 2.0 and changing retirement rules. Visit retirewithmerkle.com to register for an upcoming workshop. Your retirement journey starts now.
Welcome back to Retiring Today. I'm here with Loren Merkle, and we are talking about retirement as a mindset shift. So we want to help you rethink retirement and get in a better position to retire. So one thing you have to do, build a recession-resistant portfolio. I think you talked about why it's important, but now we really want to go just a little bit deeper here with mindset shift. Number 2, you want dependable income. We're going to talk about exactly how to build that portfolio.
And that's also a part of the why. You want, because you're going to deliver the income, which delivers your lifestyle based on the investments. That is the real why. And the investment experience that people go through in retirement does also deliver a lot of the anxiety that people go through. When we turn on the news and we see that the S&P is down 20% this year and the NASDAQ is down 34%, that creates anxiety because all you can think is, what is my portfolio doing? Because all you can think then is, that is going to impact my ability to retire or stay retired. So the recession-resistant portfolio is absolutely imperative. Now it's a matter of how do you create that? Because most people have probably not heard of the concept recession-resistant, and many people just kind of feel hopeless. Like, I've always invested this way, that's the only way I can invest. But technology has advanced to a point where we don't just have to have stocks and bonds in the portfolio. In fact, we shouldn't just have stocks and bonds in our portfolio. Institutional investors, I'm talking about the investors who manage billions and billions, sums of billions and billions of dollars, like the big pension plans, foundations, those managers. In the 90s, they would have about 90% of their portfolio invested in stocks and bonds and about 10% in alternatives, because that is what it was available to us back then. And by the way, back then, the stock bond portfolio worked relatively well. When stocks were down, bonds kind of held everything up. But we've seen that hasn't been the case in the last couple decades. So now these same institutional managers, which, by the way, they can invest in anything they want to with all their expertise and the resources they have available to us, they are actively choosing to flip the switch. And so now their portfolios are about 40 to 70% alternatives, somewhere around 60 to 30%, in some extreme cases even 90%. 90% alternative. So in some extreme cases, it's only 10% that is stocks and bonds. Because of what these big institutions are looking for is the same thing that retirees are looking for, which is consistency in income and consistency in the flow of their portfolio value.
Yeah, if you read about some of those endowments, billions and billions of dollars, it is interesting to see how they've changed their investing philosophies. Like Harvard, I think, has one of the largest endowments in the country, and you can read about that, yeah.
And they changed it because they can. What most people don't know is you can too. And now it's a matter of how do you do that. So if we're not investing in just stocks and bonds, we're using some of these other vehicles. What are those? It's a whole host of alternatives that you now have at your disposal to create this recession-resistant portfolio. You can use structured notes, you can use buffered ETFs, you can use fixed indexed annuities, you can use CDs, you can use bank products. There's a whole bunch of products that you can use that is outside the category of stocks and bonds. It's just a matter of trying to identify what it is that you're trying to accomplish from a retirement standpoint, which means how much risk do you need to take in your portfolio to accomplish what it is that you're trying to accomplish. How much risk is too much, so when the markets do blow up, your portfolio it would also blow up. And then how much is too little, which means that you're not taking enough risk to beat taxes, beat inflation, and then grow the portfolio on top of that.
I know you love a good pie chart, right?
I do.
You like a good pie chart? Okay, let's put a couple up on the screen. This first one is the 60-40 portfolio. We're putting the red line through it.
We're crossing that out because that was the old way. And what you used to do, which got you to the place, isn't what's going to get you to your next transition, which is the retirement. So that is off the table.
Okay, here's our next pie chart. You ready for this one? This is what it could look like. So you kind of mentioned some of the alternatives. Would you call this one that's on the screen right now maybe a suggested kind of portfolio construction as you move into retirement?
This is an example of what it could look like, and we call this the 50-30-20, where it's 50% stocks and or 50% stocks, 30% alternatives, 20% bonds. You could flip those numbers too, and some people might be more of a 40-30-30, right? It just depends upon what your specific retirement goals are. The key is that you have to be really intentional about what your portfolio construction is, and the big takeaway is the 60-40 is out. It has to look something different. You have a lot of tools on your side to do that, and now it's a matter of making sure that your portfolio aligns with what it is you're trying to accomplish. And then the other thing is you have to have a good understanding of how much risk you're actually taking. And this is where the surprise comes in and the anxiety increases for most retirees, because most people don't have a really good idea of how much risk they're actually taking. So when we go through this next recession, how much is your portfolio going to go down? If you have $1 million invested in a portfolio, and 2024 brings a recession, which a lot of people think is going to take place, is your $1 million going to go to 700? Is it going to go to 600? Is it going to go to 800? What is it going to go down to? Most portfolios will go down. It's just a matter of how much, and is that going to really disrupt what you're trying to do from a retirement standpoint?
And we called the mindset shift for this one dependable income. And when I hear dependable income, there is one other thing that comes to mind, and that is annuities. I think that is sometimes talked about in that way. Is this part of that conversation when people are making that mindset shift to retirement?
It certainly can be. Certain types of annuities can be a part of an effective recession-resistant portfolio, but not all annuities are the same. Within that annuity brand, there are many different types of annuities. There's variable annuities, there's fixed annuities, fixed index annuities, immediate annuities, deferred annuities. There's
of course there are.
Single premium. I mean, there's a lot of different
Sure.
types of annuities. So when you think about any type of investment, just like stocks and bonds, there's a lot of different types of stocks and bonds. There's a lot of different types of ETFs. There's a lot of different types of annuities. So when it comes to building your portfolio for your retirement, we want to stay away from painting everything with that broad brush and using more of a surgical approach and saying, these stocks and bonds are not good for you, this is why. These stocks and bonds are really good for you, this is why. These annuities are not good for you, this is why, right? That's the approach that you really need to take, and that's the approach that we take with the families and individuals that we work with. We design their portfolio based on their retirement, not on the families or individuals that we met with an hour ago or that we're going to meet with the next 2 hours. It's your retirement, it has to be your portfolio because it's your lifestyle.
One last thing when I think about investments too in retirement is growth. Do people need to shift their mindset on their expected growth in their portfolio because they are pulling out of the market a little bit more?
Well, potentially. What you're really trying to do from a portfolio standpoint as far as growth is you want your growth expectations to meet what your lifestyle needs are based on the portfolio that you have. And you're trying to take as little risk as possible for the most return that you can get. And that return has to be at least the minimal amount of return that it's going to take for you to accomplish your lifestyle. But whatever that is, the least amount of risk, whatever those parameters are, that needs to be set for you based on all the circumstances of your portfolio. But it's not uncommon that if you were 40 years old in your working years and you're taking a lot more risk and you might be 80% invested in stocks, that the growth expectation might be dialed down a little bit based on what you're trying to accomplish in retirement.
This conversation about investments is part of a Rethink Retirement series. So we've got workshops just for you designed to talk about taxes. We have one on income, healthcare, and legacy planning. It's all part of the Rethink Retirement series. There's a website on your screen right now. You can go there and check out more on our Rethink Retirement series, but we've got more to talk about next. Risk is up after the break.
Do I have enough saved for retirement? When should I take Social Security? Which Medicare option is best? How do I plan for inflation? Sometimes the road to retirement starts with more questions than answers. We're here to help. Join us for our upcoming Journey to Retirement workshop. Get answers and start your retirement journey with confidence. Our online workshop includes information on Secure Act 2.0 and changing retirement rules. Visit retirewithmerkle.com to register for an upcoming workshop. Your retirement journey starts now.
Anytime I have even the smallest question about my accounts or what effect the latest tax law might have on my situation, the Merkle Retirement Planning team is always there and quick to help. I'm so glad they treat you like family. I'm so happy to have such an excellent team working for my future and ensuring I do the best to achieve my financial goals.
Merkle Retirement Planning. Your retirement starts here.
This is Retiring Today. I'm here with Loren Merkle, and we're talking about why retirement is a mindset shift. So we're going to talk about that third mindset shift. It's rethink risk.
We have to rethink the amount of risk that we're taking because your lifestyle has now changed. Once you make that transition to retirement, your lifestyle is dependent upon the investment income and maybe Social Security income as opposed to the income that you produced when you were working. So when you were working, if your portfolio lost 30%, like in 2008, most people lost 30 to 60%. Not a big deal. You didn't like it, but you still had more time on your side before you're going to need, your lifestyle is going to be dependent upon your investments. When you're in retirement, if you lose 50% of your life savings or even 30% of your life savings, that can force people out of retirement or certainly change their lifestyle.
Okay, so what happens? You sit down with people and visits or maybe these 15-minute retirement checkup calls and they're worried about risk. Am I taking, not taking enough? Am I taking too little? How do you help them come to that conclusion of what's the right amount?
First, we have to identify how much risk are you really taking. We have to identify when we go through a bad market, we go through the bad market cycles, are you going to lose 20%? Are you going to lose 50%? And whatever that is, are you comfortable with it? And will that work in your overall plan? So we have to assess your portfolio. How much risk are you taking in real numbers? But then also apply that to your income plan and your retirement plan to make sure that that will still work, and then make sure that you're still comfortable with what that looks like. Because we know we're going to go through these bad cycles in the market. It's just what happens when we go through those bad times.
Yeah, I think you have an example that is really going to outline for people what can happen if you don't have a recession-resistant portfolio. Yeah,
this is what we see many times, unfortunately, when we go through these bad times in the markets, is people's portfolio experience is way different than what you anticipated. So in this example, we have a single retiree. Her name is Jill. She has $1 million of portfolio that she is going to be dependent upon for income in retirement. She has Social Security, but just from her investments, she's going to need to take out $38,000 from her investments, which is about a 3.8% withdrawal rate. Now, most studies would show that taking out 3.8% of your portfolio in retirement should work long term. So when Jill starts taking out this money in retirement, she's feeling confident that not only is this going to produce the lifestyle that she wants to now, but also 10, 20 years down the road in retirement. However, we already know that the markets are going to do what the markets do. And when the markets go down 25%, Jill's portfolio also went down 25%. So instead of having $1 million, she has now $750,000. But Jill has grown accustomed to this retirement lifestyle. She likes having fun with her grandkids. She likes having fun with her friends. And she doesn't want to change that lifestyle and that fun just because the market went down, which she can't control any of that. So she has a choice. She can continue to take out 3.8%, but it's no longer of $1 million, it's of $750,000, which means that she's going to take a big decrease on her income and her lifestyle. Or what most people decide, and in this case Jill did too, is that she still wants the $38,400, but it's no longer of $1 million, it's of the $750,000, which means her withdrawal rate is no longer 3.8%, it is over 5%, which is not sustainable long term. So Jill didn't want to sacrifice on her current lifestyle, but what it does do is it puts her long-term retirement lifestyle in jeopardy. And it severely increases the probability that Jill is going to run out of her portfolio before her retirement ends, which is why Jill has to rethink her risk in retirement, because her entire lifestyle for her entire retirement is dependent upon her rethinking her risk, aligning her risk with what her goals are, and what she has available to her from other income resources.
And I'm going to cut to the chase, because I don't know if you quite did it in that example. Jill ran out of money, essentially.
In that scenario, she did.
And that is what retirees fear. That is what every retiree does not want to have happen to them. And then my second takeaway from that is that Jill was taking too much risk. It didn't have to end up that way. There are probably things that Jill could have done to change that outcome.
Well, in this scenario, she stuck with the old way of doing things. She was in that still that same 60-40 portfolio. She might even stayed in that life or the target date 2030 fund that she did when she was working. Either way, it wasn't recession resistant, which means when we went through the recession, her portfolio was impacted severely. She didn't rethink her risk, she didn't realign her portfolio, and didn't use alternatives to make it recession resistant, which means that her retirement outcome didn't take place. It didn't result in the way that it otherwise could have.
Yeah, that makes a really good case for why you need to rethink a lot of things when it comes to retirement. Here's a great resource, because it's not just investments, it's taxes, it's healthcare, it's legacy, it's income. You have to rethink nearly everything when it comes to retirement. So here's some workshops designed to help you do just that. There's a website on your screen right now. You can go to a workshop that interests you or watch them all. The good news is you can watch them at a time that's convenient for you, and it's all complimentary. These workshops will help you rethink retirement and help you be in a better position when you get ready to retire.
And it'll give you a lot of ideas that maybe you haven't thought of before. And one of the hardest places to start a plan is, where do you get started? How do you get started? What is a retirement plan? You'll find all of that with the online workshops.
So there is a lot of great information there, but we like to think there's a lot of good information on this show too. It's Retiring Today, and we thank you for watching.
Do I have enough saved for retirement? When should I take Social Security? Which Medicare option is best? How do I plan for inflation? Sometimes the road to retirement starts with more questions than answers. We're here to help. Join us for our upcoming Journey to Retirement workshop. Get answers and start your retirement journey with confidence. Our online workshop includes information on Secure Act 2.0 and changing retirement rules. Visit retirewithmerkle.com to register for an upcoming workshop. Your retirement journey starts now.